Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Canada's economy posted modest growth in February. Data from StatsCan shows GDP rose 0.2%, in line with expectations and following a smaller gain in January. The increase was driven by strength in goods-producing industries, including manufacturing. Early estimates suggest growth stalled in March.
GDP was basically flat in the month, that there was no change. But it's hard to tell if that's an oil price story or if that's, just something that we're seeing, with the sort of conflicting forces in the data and in the economy. So 1 month doesn't necessarily make a trend, but certainly we will start to see the impact of that oil price shock starting to show up pretty materially in the GDP data, as we have already with inflation.
Shares of Bombardier seeing a surge after the jet maker posted strong first quarter results with both profit and revenue up from a year ago. The company says the results were driven by deliveries as well as strong demand for maintenance and support work. Bombardier also saw a sharp rebound in free cash flow and raised its full year outlook. Shares of Spin Master are also getting a boost, up 13.9% on the day. The toy company posted a smaller than expected loss in its latest quarter, helped by cost controls and maintained its full year outlook. Revenue also came in ahead of expectations. Sales in its entertainment segment also jumped 8% compared to the year before. Here is where we are on the market. It's been a good day for the TSX. It is up right now 596 points, or 1.8%, about just short of 34,000. Moving south of the border. Also in the green today, the S&P 500 gaining 1%, is up 76 points. Take a look at the Dow. It's up 1.7%, over 800 points. And the NASDAQ up almost 1%, 0.95. That's a 233-point gain on the day. Shares of Whitecap Resources rose today after the Canadian oil and natural gas company reported first quarter cash flow from operations that exceeded $1 billion, so more than double the $446 million reported a year ago. The increase driven by higher production and then late quarter surge in oil prices we have seen because of the Middle East conflict. Let's go to Grant Fagerheim. He's President and Chief Executive Officer, Whitecap Resources. Thanks for joining us today.
Thanks, Marla.
So operating cash flow more than doubled in the first quarter. What would you say the main reasons were? We know that obviously there was the price increase in energy, but what else was behind that?
Really, it was operational performance. I mean, we produced, as we talked about, 391,000 barrels a day of production in the first quarter. And with the, 62% of that being crude oil and liquids. So with the advanced pricing that we did see for the month of March, since the Iran invasion on February the 28th, we've had a very strong commodity price environment where we put 60% or 62% of our product. But ultimately, it falls back to operational performance. Team here at Whitecap has done a marvelous job on exceeding our expectations for the quarter by about 18,000 barrels a day of production. Sets us up very well for the balance of the year. So I think we're in a very good position, and we have a blend of commodities: light oil, liquids, and natural gas. So we can move our capital around as we see fit. But the first quarter was based on the fact of outperformance that we weren't anticipating, and the high commodity prices that we weren't anticipating in the what we call the March time period.
Okay, profit I know fell because of hedging losses of $530 million non-cash, but can you tell us a little bit more about that circumstance?
Yeah, what you've got is, as we as producers in Western Canada, you take advantage of the forward market. And in the forward market, specifically for the month of March, prior to the invasion, we had a hedging program that was in place, and you're hedging at lower prices for an extended period of time. Now, the purpose for hedging is not, we're not trying to beat the market. What we're trying to do is stabilize our cash flows in order for our capital program and dividend to be paid on a consistent basis. So that the hedging loss, using that terminology, is because we had hedged off a portion of our production for that quarterly time period of time before we'll call it the crisis that we're in from a pricing perspective now.
Okay, so how much of your 2026 and 2027 production is hedged?
So right now, we're in the neighborhood of, for 2026 on crude, we're about 32 to 34%. 33 actually if you average it out. And on crude for 2027, we're at 23%. On natural gas hedges, we're 29% in the first half of 26, 28% in the second half. And for 2027, at this time, we're only 13% hedged for 2027.
Okay. Let's talk a little bit about the fact that you've gained from the higher prices for energy. That being said, not all of it is included in the earnings that you have shared. It's only 1 month, I believe. So tell me what you're looking forward to next quarter, what the impact could be there if the conflict carries on.
Well, in essence, you've got the longer this goes, the longer the disruption takes place in the Middle East. Commodities are going to be higher for longer. And we talk about this in not in weeks or months, but maybe in quarters or I wouldn't say stretch it into years at this particular time. But the commodity prices are going to remain elevated relative to crude oil and liquids that the world so badly needs. So from an overall perspective, crude, and we expect crude and natural gas prices, or crude and liquids prices to remain very strong. And we can get more takeaway capacity. Natural gas prices should recover sometime when we get incremental takeaway capacity out of Canada, whether it's over to Asia or into the United States.
You mentioned boosted production for the year. How much was the Verican acquisition helping that?
Well, putting the two asset bases together has been fantastic. I mean, the synergies that we've been able to realize with the people, the processes, and on capital and operating costs has been much greater than we anticipated. So now you've got a very contiguous land set to work your skill set. If I can hand it off to our people, let them work it, and they've done a marvelous job. There's some very good people we brought on. Between the two organizations, we tried to pick the best of the best, and we think we've done that, and hand it over to them to drive as much operational performance as we possibly can. We have to be very proud of what we've staffed as to what they've been able to accomplish so far.
With the cash flow boost that you are seeing, what do you expect to do with the money? Can investors expect perhaps some sort of increase in dividend, share buybacks? Is there another acquisition you're looking at?
Yeah, at this time, I mean, what we're doing, our capital program for the year is $2 to $2.1 billion, on estimated to be right now using the forward strip about $4.3 billion of funds flow. But we're not increasing our capital program at this time. We're staying with it. And we've used a countercyclical approach to investing. When commodity prices are high, it's a good time for us to make sure that we strengthen our balance sheet. I mean, our debt to funds flow right now is 0.8 times. But on strip pricing, we would drop down to 0.5 times. We'd take our debt to $2.2 billion versus $3.2 billion. So that is a preferred place for us at this particular time, and that provides you with maximum optionality. Should we decide to increase our capital program at all, it would really be to uplift our 2027 production numbers. So we would do that, sometime for fourth quarter capital, if we did that at all. At this time, we'll stay the course. Take the incremental cash flows. We don't know how long this disruption is going to take place. We expect it to be longer and commodity prices to remain higher for an extended period of time, but we don't know that. We can't jump ahead of the market on that. So from our perspective, and that allows you then the optionality late in this year or next year from a dividend for share buybacks, whether it's to increase your capital program for organic growth or acquisition activity into the future. We've got such an enviable inventory of opportunities in front of us with 10,500 wells in inventory. We're not in a race to get out and add more inventory. We're only drilling 265 wells this year on that 10,500 well inventory set. So I think we're in a good place. Again, demonstrating to our shareholders that we can actually create incremental value as we've done, with the first quarter. We've got, 9 quarters now. We've beat our estimates, and we want to continue with that on behalf of our shareholders.
Okay, I do have to leave it there. I'm out of time, but Grant Fagerheim, President, Chief Executive Officer, Whitecap Resources, thank you for your time today.
Marilla, thanks very much, everyone. Thanks to you and to everyone.
Take care. Coming up, Canada's GDP grown for a 4th straight month. We're unpacking the big picture when we come back. StatsCan says the economy has grown for a 4th straight month with a 0.2% increase in GDP for February. Let's go to Michael Davenport on this. He's senior economist at Oxford Economics. Thanks for joining us today.
Good afternoon. Thanks for having me.
So some strength in manufacturing here, but when you look under sort of that banner, it's machinery and transportation doing well. Any obvious reasons for those?
Well, there were a few kind of one-off factors in February that boosted the manufacturing sector. The biggest one was the end of extended maintenance at auto plants. So essentially, right around the holidays, there was an extended period of shutdowns for auto production in auto facilities in Ontario, a couple of auto facilities in Ontario. That led to big drops in auto manufacturing production in the month of January, and we saw that unwind a little bit. So those temporary disruptions faded, the maintenance ended, and so that led to a rebound in manufacturing activity as well as wholesale trade activity, and to a lesser degree, transportation and warehousing activity as well in February. And so that really helped to support the headline GDP growth number, helped to support that strong growth number for manufacturing. But overall, the manufacturing sector continues to struggle. I mean, it's been declining pretty consistently, not only since the trade war with the U.S. began in early 2025, but even going back, it's been in a secular decline for years. And so while the growth number for February was quite strong, again, it reflected those temporary factors. Doesn't change the fact that the manufacturing sector continues to struggle.
Okay, so that brings me to my next question about whether or not you are seeing or feeling a little bit more optimism from businesses which were hard hit last year by tariffs in general.
I think there might be signs of some optimism and sort of some early signs of a recovery in exports. However, overall, I mean, we think what businesses are really waiting for is a bit more clarity on U.S.-Canada trade policy, especially ahead of the upcoming USMCA review. I mean, really, we think that represents a key fork in the road for Canadian businesses and the Canadian economy more broadly. If we do see a positive USMCA review with, a reduction in Canada-U.S. tariffs, a little bit more certainty for Canadian businesses that they will have access to the U.S. market, free access to the U.S. market, or something close to that, we do think that will lead to a rebound in business investment, a rebound in industrial production. However, right now, I think a lot of businesses are still waiting to see how that develops.
All right, the holding pattern continues. Public sector weakness for February. Is that from job cuts or something else?
Yeah, it's hard to say. I mean, I think the broader public sector was definitely weak. We can see volatility month to month in those numbers. However, overall, we have seen a broad flattening profile in public sector, the broader public sector GDP over the last several months. I think that in part reflects some of the moves from the federal government to sort of rein in spending on public administration and sort of start to really lean out the public service. And so while it's hard to read too much into one month, I do think that's what we're seeing in terms of the broader trend of softer growth in public sector GDP.
What are you noticing in the consumer-facing sectors?
Yeah, so the consumer-facing sectors definitely overall, if you look at the big picture and step back over the last, let's say, 6 to 12 months, consumer-facing sectors have been quite soft. So we've seen retail trade really remained quite weak and flat over the last year or so. The first quarter, we saw a bit of an uptick in retail spending, and we think that translated into broader consumer spending as well. However, overall, the trend has been quite flat. We've also seen, a combination in food services, other arts, entertainment, and recreation services. Those have also sort of softened quite a bit. We think there are a number of headwinds that are really feeding into this sort of weaker, broader consumer outlook and performance for the Canadian consumer. It reflects, of course, the fact that the population is now shrinking, but also increasing financial strain on many households because of the large number of mortgage renewals at higher interest rates this year. All those people that took out mortgages during the 2021 and 2022 housing boom at quite low rates, a lot of them are starting to renew at much higher rates. So that's another key factor that we think is weighing on the consumer and will likely keep underlying consumer spending momentum quite subdued as we move through 2026.
So, Michael, I know that the flash estimate for March seems to be flat, but we're also seeing this boom in energy prices that ended up being longer than many had anticipated. So I'm wondering if that could be much of a benefit that wasn't looked at for the month of March.
Yeah, so StatCan's flash estimate for the month of March is flat. That's pretty much in line with our expectations as well. There will be a positive offsetting boost to the Canadian economy in the near term from higher energy prices. Of course, an energy price shock for the Canadian economy affects it quite differently in different sectors and different regions. So in Ontario and Quebec, consumers and businesses are feeling the pinch, feeling the squeeze of higher energy prices. It's directly raising costs for them. For consumers, it's squeezing their disposable income. For firms, it's squeezing their margins. At the same time, firms in Alberta and Newfoundland and Labrador, energy-producing regions, they are doing quite a bit better, particularly firms in the oil and gas sector, and so that is providing a positive offsetting boost. We do expect there to be some modest lift in oil production in the second quarter. That is going to help offset some of the drag on the economy from slightly weaker consumer spending. And so that is what we're looking for. However, in the near term, we don't expect there will be that large of a boost because of the fact that there is limited capacity for Canadian oil producers to ramp up production, but also to export that higher production of crude oil, those extra barrels of crude oil, because of limited pipeline capacity and rail capacity.
Michael Davenport, great for you to join us, sir. Michael is senior economist at Oxford Economics. Thanks for your time.
Thank you.
When we come back, we'll look at how markets are reacting to earnings. Back in a moment. Markets making some pretty big gains today. The TSX up over 600 points right now. Much of this is on stronger earnings that are being released. Our next guest says evidence is the name of the game right now. So let's go to Steve Rolls. He's Senior Portfolio Manager at Trivest Wealth Counsel. Steve, thanks for joining us today.
Hi, great to be here. Happy Andy Day.
Happy Andy Day. You are looking at investors and you think they're looking for proof, not just theories, not stories. Give me an example of a company that is providing that proof to you.
Yeah, great question. It's really a day of coming off to yesterday when looking at all the AI earnings and everybody's looking at, okay, what's the return on all the CapEx that's been the momentum for the past 6 months here. And looking at the portfolios right now, what I'm really trying to do is try to really select proper portfolio construction in a way that's offering some AI benefits as well as offering some security. So what we're really looking at is companies that are proving that the economy is not gangbusters, but it's actually proving that it's strong. So I'm looking at companies in energy, looking at companies, the railroads yesterday, and other sectors that are old school economy.
Okay, so let's talk about railroads for a moment. Canadian National revenue below expectations and changes in trade, still a headwind for company and for transportation sort of more generally. So would you invest in railroads today?
Yeah, I look at it as a long-term investment. We're seeing that yesterday wasn't a gangbuster report, but it was a strong report. And it has gotten some momentum over the past couple of months here. And it's a clean report, margins remain strong, capital discipline remains strong, operating efficiency remains strong, and more importantly, cash flow is strong. So there's some opportunity there that while we wait for more clarity on trade policy and whatnot, we're still getting paid, and it's effectively a buy and hold strategy that's great for long-term investing.
Let's get to metals. I know you like Agnico Eagle. Lots of people do. I'm just wondering why, or if you feel that gold has some room left to run.
There's still room to run in gold. I'm looking at quite positive on gold right now. That you have to look at who's buying gold right now, and there's record buying continues with central banks. We're seeing some stablecoin buying from that, and we're seeing some investors continue to hold gold for long-term geopolitical risk uncertainty as a hedge against that. And overall, looking at Agnico, they got earnings coming up shortly here. That they're adjusted all-in sustainable cost is about $1,450. Well, the gold price is, as we're seeing right here, about $4,600. So it's really a license to print money right now in the right place, right time. And more importantly, that with Agnico, you're really investing in low-risk type of environments with Canada and Finland.
Let's get to energy then. Of course, we know it's going crazy right now, depending on what news comes out of the Middle East, generally speaking. So all sorts of energy stocks are benefiting from that. Would you put new money in today, considering we don't know when the conflict's going to end and where oil, for example, will land?
Yeah, it's one of those situations. Nobody knows how this is going to play out. Intuitively, I think it's going to take longer than we expect. I think we saw negotiations with the U.S. and Iran back in 2007, just after the change of government in Iraq. And I think we're seeing some similar type of debates going on there. So I don't see a short-term effect here, but I think that the damage is done. I think Eric Nuttall pointed it out at a great breakfast yesterday that the damage is done. It's going to take a while for this to come back. So in the meantime, buy great cash flowing producing Canadian energy companies like C&Q and Suncor, and get a great dividend while we wait and continue to have more momentum in the oil sector.
Where are you landing today in industrials?
Industrials right now, the name of the game right now is Caterpillar. Great demand. They're covering all bases on their construction side with the CapEx spending. They're really flying on all cylinders. Their AI demand and their power generation is flying on all cylinders, and as well that the mining is really coming back into play. So they're a diversified company. I am a little concerned about their valuation a little bit, but if there's a dip, I would get in there right away. I think that it's a company that's showing great resilience. Revenue was up over 25% reported yesterday in backlog orders. So it's a win-win for Caterpillar.
Steve, got to leave it there with you. Thanks for your time. Appreciate you joining us on The Close.
Great. Thank you very much.
Let's have a quick look at the markets ahead of the break and the end of the trading day. It's a green stream here. Take a look at the TSX. It's up 600 points plus. We're back with the end of day numbers in a moment. Here are the closing bells for the end of the trading day at the NASDAQ. You can see the astronauts from NASA's Artemis 2 mission. They have the honor of ringing the closing bell after their successful. Oh, look, they're doing that all together. All right. New York, Ray's Summit ringing the closing bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. We have the TSX Composite gaining 645 points today, almost 2% just shy of that. The S&P 500 is up 1% or 73 points. I believe that's a record. We'll double check in a second. The NASDAQ up 219 points or 0.9%, ending the day at 24,892. Let's get to the movers in Toronto. We'll start here with Bombardier. It reported and it is up 20.6%. That's an increase of $49.33 a share, taking the share price to $288 today. It's up 210% over the last year. We're going to have more on that from Stephanie Hughes, I believe, in just a moment. Let's get to Gildan. It is also gaining on the day. Gildan up 9.5% or $7.33, taking the stock price to 84.30. Moving on to Lithium Americas, it is a gainer of 5% today. Sorry, 15%. I missed that. It's up $1.03, taking the share price to $7.80. And in the red today, we have Allied Properties REIT. It is down 3% or 32 cents to $9.84. And late movers to take over in losses is Alamos Gold. It dropped 3%. It's down $1.73 today. And then Allied Gold also losing today. It's down 1.5% or 62 cents, taking the share price to $40.84. Let's go to Bloomberg's equities reporter Stephanie Hughes. She joins us now with news on the movers. Bombardier reported boosted cash flow. Tell us more what's going on with them.
Yeah, that's right, Morella. So Bombardier was a high flyer, just soaring above all the other TSX listed names today with its over 20% gain at its highest point, which made it the private jet maker's best trading day since July. And that's thanks to a solid showing in its first quarter results, where its free cash flow and adjusted earnings came well ahead of what analysts were expecting. But more importantly than that, it was Bombardier raised its free cash flow guidance to above $1 billion. That's coming above a range of $600 million to $1 billion, and also beat expectations. So it's checking a few boxes there. Analysts largely said that given this guidance update, the lack of big changes to the company's path forward, all that is inspiring confidence, their confidence in the company, and clearly investors agree when you look at that chart there. So analysts like Scotiabank's Konark Gupta say they continue to like Bombardier and management's growth execution while the business diversifies and they tackle down debt. So with these gains, Bombardier, last time I checked, was on track to close at its highest level since 2002. Pretty sure it managed to stick the landing. And if you look at it over the past year, that's a nice one-year chart there. It's gaining by a significant lead, over 200%. So anybody who bought a year ago, probably pretty happy with that decision now, Morella.
Okay, let's get to Gildan, which makes clothing. They also reported. Give us some of the details there.
Yeah, that's right. So it's another earnings winner today, Gildan Activewear. It's a blank T-shirt apparel company. People with branded T-shirts in their closet might find Gildan's tag on a few of them. So that company, those shares gained by over 11% at their highest point, which was that company's biggest intraday boost since August. And earnings before, that's because of the thanks to a net sales beat in the quarter. And on top of that, we saw earnings before factors like interest, taxes, and other variables also beating the street right there. The company also added that the progress that they're making with integrating the recently acquired Hayden's brand segment is into the broader business is chugging along. They're making progress on that. And that's a very important point because the last reporting period in February, some of the integration hangups were causing a messier quarter, and that's what ultimately led shares to fall a bit there. So analysts like TD Cowen's Brian Morrison said the beat maintained guidance should shift the market focus away from those integration risks and put it squarely on the earnings per share acceleration that Gildan has been able to show today. However, these concerns, they also added, will stick around for the second quarter. It will just be a little bit less onerous. Executives said that they're keeping an eye on international trade risks and geopolitical tensions coming from the war in the Middle East. And these are two potential headwinds just coming from a tariff price shock or an energy shock when they're trying to move these products around. So they'll have to navigate all of that. All told, it's still down. Gildan Activewear is still down on a year-to-date basis because of that February drop. But if you look at it over the past 12 months, over the past year, it's still hanging in there, hanging into the green, Morella.
All right, hanging in is good. Bloomberg Stephanie Hughes, appreciate that update. Let's get to movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz joins us from there. Bailey, we were talking about Caterpillar earlier today. It is up today after raising its long-term outlook. Walk us through that.
Yeah, raising its long-term outlook and, according to analysts, really firing on all cylinders, and that's why the stock closed at a record high and had its best day in more than a year. This is a company that has benefited from the entire push into data centers and everything around building out AI, as well as their fundamental business. So when you look in the near term, kind of layering those two together, but in the longer term, kind of their ability to continue to pull down different levers, as you can see, last 12 months really doing nothing but moving up and to the right. And the interesting thing to keep in mind as you compare Caterpillar to a stock we're going to talk about in a little bit, in Alphabet, these are two companies that are up almost the identical percentages since ChatGPT was unveiled back in November 2022. So just put that in perspective, up about 277% over that time frame. So this is a company that has been benefiting from an investor push away from things like software and really into industrials, but again, firing on all cylinders and beating expectations across the board.
Let's get to Eli Lilly, also jumping on earnings. Are they winning the GLP-1 race?
They are winning the GLP-1 race, and they're winning because their ability to diversify and kind of draw in demand. As you can see, not really where they were trading towards the end of last year, and that's obviously been a big debate. But if you overlay Eli Lilly against Novo Nordisk, the two kind of dominant players in the GLP-1 obesity drug debate or at least competition, Eli Lilly is vastly outperforming. So when they beat expectations, they raise their outlook on that strength. It is continuing to be a franchise that is delivering growth, and that obviously has been top of mind for investors when there's a lot of talk about copycat drugs or generic drugs. I know those have been rolled out in Canada, and that's something certainly we've been talking about here in the U.S. for quite some time, how that impacts the likes of Hims and Hers Health. But nonetheless, it does seem like Eli Lilly, again, at least from this update and at least for their expectations for the remainder of the year, not seeing any really slowing down from that front as it relates to obesity.
Okay, let's get to the Google parent company Alphabet. It reported earnings with a lot of the other big tech companies yesterday, but investors gave a nod to Alphabet specifically. Tell me about why that is.
Really strong growth as it relates to AI, but benefiting from two things. In particular, strength for search driven by AI. It does seem like that Google is not losing out on that front, which obviously has been a big debate. Would people be using ChatGPT in place of that? And how is that playing out? It seems like they are continuing to dominate and drive growth there. And also cloud, really blowing past Wall Street expectations. When you look at their back order, well above what analysts on the sell side had been penciling in. So this is a stock that, just to keep in mind, in terms of market cap gain today, more than a Netflix. So that is a huge gain for a company, closing at a record high, best day in more than 2 years. Again, another example of companies that are firing on all cylinders. Maybe I went a little bit too far in picking three stocks that had some of the best performance in the S&P 500, but these are three companies in very different industries that we saw delivering on earnings in the last 24 hours and change.
Yep, and definitely boosting the confidence of investors moving along. Bloomberg's Bailey Lipschultz, thanks for that. Coming up, taking on the wall of worries for investors. Back in a moment. There are always risks for investors that change constantly. What are they right now? We will find out from Michael Monahan, partner and portfolio manager, founder, ETFs. Thanks for joining us today.
Thanks for having us. We're glad to be here.
You see three fronts here for worries for investors. What are they?
So right now, we think there's three waves moving through the market. Number one, you have the geopolitical friction, the Middle East instability, oil price, inflation, and supply chain risks. You see the AI CapEx cycle. We're seeing that in the numbers reported the last several days. Huge CapEx increases from the likes of Google, Amazon, Meta, Microsoft, the hyperscalers. And the third piece is the employment shift. That is the critical question of whether job creation can outpace some of this AI-driven displacement.
Okay, so let's talk about disruption of AI, which has been a topic of conversation for some time. But you see opportunities inside the disruption. What are you looking at?
So we're looking at the spend right now. So, we invest in founder-led companies, and we're starting to see that, very high spend within the AI complex, benefiting names like NVIDIA and Oracle. And we're constructive on it long term. We think that if you look at growth historically across innovations, whether it be the steam engine, electricity, the internet, let's take the iPhone. The iPhone replaced about 30 different devices from camera to calculator. And in each one of these displacement cycles, we develop new industries. For example, the smartphone burst, food delivery apps, ride share, and mobile payments. We're very constructive that, yes, there'll be some destruction from the AI supercycle, but we see growth coming just as rapidly.
Can I talk about employment as it concerns AI? You mentioned a little bit about that. And I'm just wondering, now that we're beginning to see AI sort of resculpt labor, whether you think that more employment will be gained or lost as a result of AI. What's your thesis on this?
So our thesis, as we stated, is in all of these cycles, if we look again, looking back in history, we have some destruction of near-term industries, but we generate new industries that haven't even been thought of. Again, the iPhone destroyed about 30 different products, or at least took a big share of it, but introduced huge segments like ride sharing, food delivery, mobile payments, and others.
Interesting. Okay, so let's talk about a couple of stocks you like. Moving forward, Palantir is the first one. What are you looking at for Palantir?
So Palantir, we're very favorable on, very strong, over 100% year-on-year revenue growth, over 100% year-on-year bookings growth. And if you look at the Rule of 40, they put up, I think, 127% in their last quarter. So we continue to think that Palantir is going to add to their top line. It's not just a government story at this point. It's strong wins within the corporate side. So we think we're going to see continued revenue growth along with margin expansion. And I think we all know that when revenue goes up and margins expand, stocks tend to do well. And
this is a company that would employ AI pretty heavily.
I think, it's safe to say that Palantir is one of the leaders in AI and automation, and looking across disparate data silos. That's where they're getting these big wins in corporate America, is across large institutions that have a ton of data that's been siloed in the past. And Palantir is able to look in and make sense of all this data that was previously siloed and not making a full picture. Now this data is turned into a mosaic that can be used to make better decisions for the business.
Let's get to another stock you like, which is Salesforce, which has had challenges lately because investors are worried about AI eating that business. What do you see that you like about it, and do you think it'll gain back here on a reasonable timeline?
We're very constructive on Salesforce, both in the near, medium, and long term. We think that Mark Benioff is a great example of a founder. One of the things that he's doing right now is he's shifting the business to not just be per seat, but also selling business on per compute unit. That business is growing very fast. So same thing for Salesforce. We see revenue growing. We see margins expanding as it takes less people to deliver services to their end customers. And finally, on your point, yes, these stocks saw very big multiple compression, but we think that 2 decades super cycle of SaaS and enterprise software growth, we think it's now bifurcated. You're going to see companies like Palantir and Salesforce that have a truly differentiated product that benefit from AI. They're going to continue to have high earnings growth, and you'll continue to see them hold their multiples. And some of the names that are more commodity, look at what happened with ServiceNow the other day, are names like Intuit that tend to be more of a pure commodity. We think names like that will be under pressure, but names like Palantir and especially Salesforce, we think will continue to grow.
How are you balancing the portfolio right now? A lot of investors are conflicted about where to put their money in the shorter to medium term because there's so much going on.
So we're very long-term investors. We think minimum of 5 years, and we like to look out 10, 20, or 30 years. So we run a portfolio that tends to have some of the similar weights of the S&P. So we obviously have investments across enterprise software and financials, but we have investments in the consumer. We own Monster Beverage. We have investments even in industries that might seem boring. Waste Connections is a founder-led company. So we're invested all across the economy. And for us, we think very long-term out and have seen some of these near-term disruptions as really being an opportunity for our investors.
Michael Monahan, I have to leave it there. So thanks for your time. I appreciate it.
Thank you for having us.
Coming up next, our conversation with CEO of GFL. Back in a moment. GFL Environmental reported first quarter results today that came in ahead of expectations. The company says performance was driven by strong pricing, margin expansion, and continued deal making. GFL also raised its full year guidance. To talk us through the results and what happens next, we're joined by Patrick Dovigi, founder, CEO, GFL Environmental.
I think it's just been a culmination of a lot of things, particularly just things we put in place really over the last couple of years and investments we've made in the business. Particularly around some of the Canadian assets and extended producer responsibility, and then some of the self-help levers around pricing, procurement, and just rationalization of sort of corporate SG&A, et cetera. It's just, particularly over the last 4 to 5 quarters, you start seeing, outsized margin expansion. And I think you just saw that roll into Q1 this year. And, I think things are just moving along as we had articulated previously. And I think you're just seeing it all come to fruition now.
And there must be some weak spots or things of concern?
Yeah, I think, listen, the macro economy and, the uncertainty, particularly both in U.S. and Canada, particularly around tariffs, and now sort of, global macroeconomic fears and just the uncertainty that's putting in people's minds on both sides of the border, I think, has slowed down construction and demolition volumes for sure. Little bit of uncertainty around rising interest rates, et cetera, where that's going to settle, particularly around inflation. But I think, that's the beauty of owning a waste business. There's not a lot that can materially move the needle, and we'll just react to whatever the situation exists out there.
The waste always has to be moved. Now, you described the business as resilient. Is that what you're referencing then, that there's always that for you?
Listen, it's a very durable waste stream. It's a very diversified income stream. I mean, we have multiple customers, whether it's commercial, whether it's residential, whether it's recycling, whether it's industrial volume. So I think, the business is very well diversified, which, yields the result that it does. And I think that's why you own waste, for not having a lot of volatility in up cycles and down cycles. And, I think we're just proving out that thesis as we continue moving forward here.
Is that what gives you the confidence with the challenges of the macro?
Yeah, I mean, we raised guidance. The M&A environment continues to be, very well at the same time. So I think that gave us the confidence. I think from our perspective, commodities have bottomed out here, and we think there's upside from commodities moving out in the back half of the year. So all of those things together have, given us the confidence to be able to raise guidance. And obviously with the predictability of our revenue stream, again, gives us that incremental confidence as well.
Now, one of those M&As secure. You're calling it highly complementary. How do you see it fitting in? And I know it hasn't gone through. Not everybody's happy with this deal, though, are they? Some of your shareholders.
Yeah, I think it was an education process the first two days of the announcement. That being said, I think there's been the tides have turned, and now our investor base knows it. I think when you look at these assets, again, they're very highly complementary in a market where we've been operating for almost 16 years now. And these are impossible to replicate assets in what I believe is going to be the growth engine for Canada for the next number of years. I think Canada, particularly with this government and the Liberals and the Carney government, have really doubled down on Western Canada and creating, making Canada an energy superpower. And, I think if you've seen some of the transactions being announced over the last week or two, I think that just further bolsters our view on Western Canada, again, low-cost producer in an environment today where, energy is important and energy at home is very important. And there's going to be a lot of investment made. And I think when you look at oil moving potentially from 5 to 6.5 million barrels a day over the next, number of years, I think that puts us in a very good position to be able to acquire these assets that are high margin, great free cash flow generators, and great barriers to entry into that market, particularly in a regulatory environment, Canada, that's very challenging. So to be able to get our hands on these assets, put together with our assets, I think it was going to yield exceptional results over the coming years. And I think when we look back on this in 6 or 9 months, I think our investors are going to be very happy that we took the leap of faith and made this acquisition, as we've done for the last 20 plus years. So
are these and other future acquisitions, are we talking in the near term? Can you see some more coming down, or is this a little off in the future still?
No, I think from our perspective, the lion's share of what we're going to do is in traditional solid waste. This secure business will represent sub 10% of our overall revenue stream when we go into 2027. And our expectation is that we'll just continue doubling down on the markets where we're already operating in, where we can drive the highest returns on invested capital. And this will just fit into that, big puzzle that we have both in Canada and the U.S.
All right, and you've moved the offices or the executives down to Florida. How's that going now? You've been down there, 4 months?
Yeah, I think it's been great. And listen, we're still a Canadian incorporated company, so that hasn't changed. We had to make a corporate head office change for the simple reason that we want to get access to the U.S. indices and get U.S. index inclusion. So today we should get, later in the day, there should be an announcement on sort of the Russell and whether we were included in the Russell. But, I think that was the biggest change for the move, but we're still in a Canadian incorporated company.
All right, and just one last question on anything new into the police investigation, into those, you had those 2 arson fires at your place, the gunfire, anything new from the police on that?
And there's been multiple arrests over the last 2 to 3 weeks, which we're thankful for, the hard work of the Toronto Police, York Regional Police, and Halton Police. And, I think the investigation continues to be ongoing, but we're thankful for all the hard work they did and, hopefully putting that chapter behind us.
Patrick Dovigi, founder, CEO, GFL Environmental. Let's take a quick look at the boards and where they landed today. A streak of green for the North American markets. The TSX up over 600 points today, almost 2%. The S&P a record high, 7209, up 1%. And the Nasdaq up 219 points, 0.9%. We're back in just a moment. Stay tuned. Here are the stories making headlines today. Canada's economy posted some modest growth for February. Statistics Canada says GDP rose 0.2%, in line with expectations and following a smaller gain in January. The increase was driven by strength in goods-producing industries, including manufacturing. Early estimates suggest growth stalls in March. Shares of Gildan Activewear closing higher. The apparel company posted first quarter results that did beat expectations and saw revenue coming in at a record $1.2 billion. Gildan says the integration of its Hanes Brands acquisition is on track, with higher savings expected this year. It is also maintaining its full-year outlook. Bombardier, one of the best-performing stocks on the day, it's up over 20%. After the jet maker posted strong first-quarter results with both profit and revenue up from a year ago. The company says the results were driven by deliveries as well as strong demand for maintenance and support work. Bombardier also saw a sharp rebound in free cash flow and raised its full-year outlook. Bausch Health also doing well today. It was up 1.7%. The Canadian pharmaceutical company beat on the top and bottom line for its latest quarter, revenue jumping 12% to $2.5 billion. Bausch also saw a surge in revenue in its Salix unit and its Solta medical segment. The company also reaffirmed its 2026 outlook. A tale of two markets today among the hyperscalers. Shares of Alphabet and Amazon rising, Microsoft and Meta pulling back. To break down the numbers behind them, let's go to Doug Clinton, founder, CEO of Intelligent Alpha. Doug, thanks for joining us today.
Good to see you, Morel. Thank you.
It seems as if Alphabet had the biggest run from the earnings yesterday. Tell me what Alphabet is getting right at this point.
I think it all comes down to AI. It's probably the obvious answer, unfortunately, but it's also the true answer. And if you look at their Google Cloud segment, 63% year-over-year growth, they beat the street expectations by more than 10%. I think that's really what it all comes down to, is that obviously all of the hyperscalers are spending a lot of money on CapEx to build out these AI data centers. Google's probably showing the most growth in terms of getting customers to adopt that technology. And then on top of that, they also get to use those data centers to enhance search results. Search had a record quarter too, so they're really firing on all cylinders.
Okay, so I have that Alphabet plan to spend about $185 billion US on its AI plan. They're spending a significant amount of money, but they are just ahead compared to the others, and that's why they're seeing perhaps better return on investment right now?
I think it's a little bit that they can leverage these data centers, and Meta is somewhat of a similar story, to enhance their products, which are all digital ad products. So they can take what they know about building great AI models. They can enhance their core business, which is still search today. In the future, that will probably change. But then they can also leverage those AI products and make them available to customers through their Gemini suite of products that's available on GCP. So they actually get to double dip a little more than some of the other companies where they're not developing their own AI models, like an Amazon, for example. They're relying on third parties like Anthropic, and there's still a lot of demand there, but Google actually benefits double in that case.
How is Gemini doing?
It's doing well. If I had to rank the models, Marella, and we use these models at Intelligent Alpha exhaustively, we test the models. We actually just launched an earnings benchmark product where we rank the models to see how well they do at estimating company earnings in public markets. I would put Gemini in probably third place right now. GPT and Claude from Anthropic, to me, are the clear number 1 and 2. Gemini is really close, but there is a little bit of a premium, I would say, still in the GPT and Claude suite.
Okay, so let's get to Meta. Obviously, investors didn't like the increased capex spending that they have declared between $125 and $145 billion US. Stock went down today. Tell me, is it just the fact that they are behind in the AI race, or there's a lack of clarity about what they're doing with it? What is holding Meta back?
It feels a little bit like a Groundhog's Day situation where we had kind of a similar story not much more than a quarter ago, where Meta has made it clear they are going to be aggressive in their CapEx investments. I think they're also seeing benefits for their core products in social and advertising, but they haven't really shown much in terms of what they're going to launch to the public in terms of AI products. Meta AI probably doesn't have meaningful usage relative to something like a Gemini, in my opinion, from Google. And they just put out their new model called Muse. It seems like some of the benchmarks are pretty impressive, but I think the market is still unclear in terms of how Meta ultimately thinks they will monetize these models. And so the continued aggressive CapEx, I think, is just making investors worried about getting their money back.
Okay, it looks to me like the most aggressive spender right now for this year seems to be Amazon at $200 billion US. They are up today. I know they've got sort of their hands in different pies. What do you think about where Amazon's at today and their picture moving forward as far as return on AI goes?
In some ways, they're the most interesting of all the hyperscalers, because what they've done more recently is they've been more aggressive partnering with OpenAI, made a $50 billion investment in their last round. Obviously, before that, they were already very close with Anthropic. And I think what they've done is really create sort of this Switzerland scenario where if you're an enterprise and you want to build an AI, you're comfortable with AWS, the biggest cloud platform in the world. They're trying to make it such that all these AI tools are available easily on AWS. And I think that could be a nice tailwind for AWS going forward. Now, to your point about CapEx, it also means they have to prepare for demand. All of these hyperscalers, they just don't have enough supply right now. And so Amazon does have to keep investing aggressively to keep up with Google and Microsoft.
We know that part of Meta's challenge has been, because it came around a little bit later to advancing its AI, it's paying more for components. And that definitely is a problem now, more of a problem than it was a year ago. Will that, do you think, continue to be higher cost for some of these hyperscalers?
The bottleneck always seems to shift every 3 to 6 months in AI. A year ago, it was, I think, about just GPUs. It was, can you get Blackwell chips from NVIDIA? Now the talk is all about memory. Can you get HBM? And the memory stocks have performed really well. There's a lot of talk about optics within the data centers too. And then, of course, we have the power bottlenecks. And so I think, to answer the question, eventually some of these things will get smoothed out. I think memory will take some time. I think power is really hard because it's just a physical thing, this massive physical capacity we have to build. And there's so many individual components that go into building power infrastructures to handle data centers. And so I think it will take a lot of time. Some of these bottlenecks may alleviate in the next, call it 12 months, but some of them I do think will be a little bit more persistent, especially on the power side. And that's actually been one place where we've been more focused at Intelligent Alpha, investing in companies like Vertiv, like Quanta, which had a good quarter just recently as well.
I do want to quickly get you on Microsoft as well. Microsoft, again, there were concerns about software initially. We know they've got their own Copilot AI out there. I'm just wondering where you see this company after the earnings report yesterday. What position do you see it in? Can it gain back some ground? You're looking at the share price significantly down.
One thing that I think they made clear, Morella, was that they really want to reorient their story around AI. They talked about their run rate and 100% plus growth in terms of some of the AI services and revenue attached to that. The trouble, though, in my mind, is that they, more than some of the other hyperscalers, are very much they're vulnerable to this agent revolution that we're seeing in enterprises, where as companies build AI into their existing workflows, they have more agents autonomously doing work. A lot of those agents, they just don't need tools like Microsoft Office. They might not even need access to something like Windows. And I think it will create this ongoing question about what is the future of some of these software products, even from a great company like Microsoft. And so they have, I think, a very good AI play in Azure, their work with OpenAI, but their core business is probably more now at risk than some of the other businesses we talked about from Meta and Google.
Doug Clinton, got to leave it there, sir, but thank you for your time. Doug is founder, CEO, Intelligent Alpha. Coming up next, Apple has just released its second quarter earnings. We'll share those and take a deeper look with our next guest. We're back in a moment. Apple's results are coming into the newsroom for the second quarter. Let's take a look at where this company stands right now. Revenue for the second quarter beats estimates. Earnings per share are coming in at $2 and a penny. The estimate had been $1.96. Apple's revenue coming in for the second quarter at $111.18 billion. The estimate had been $109.6. Apple's second quarter Greater China revenue, which is key for the company, coming in at $20.5 billion. The estimate had been under at $18.91. Apple is boosting the dividend to 27 cents a share. All right, let's take this information to Hadam Diab. He's managing partner, Gerber Kawasaki Wealth and Investment Management. Hadam, let's go through some of the numbers. I know there's excitement around the new CEO and what the priorities are going to be there, but let's start with the business here. It isn't spending big in the way other hyperscalers are on AI. Is that both a positive and a negative for Apple?
Hey, Varela. Yes, it is. I think, we're looking at all the other companies, the Microsoft, the Amazon spending literally hundreds of billions of dollars on AI. Apple barely spent anything, and yet they're benefiting quite a bit. If you're looking at the Mac numbers, they beat. Everyone's buying these Mac computers to run their agents. Everyone is, the services business is doing really well because we're paying 30% for Apple to run our ChatGPT or our Claude and so forth. So I think Apple, by being slow and methodical in how to adopt AI, has actually benefited quite a bit.
Okay, it looks like they're going to do $100 billion worth of share buybacks as well. That's just coming in. Memory chips are in high demand, and we know as a result of that, they're also getting more costly. And Apple, of course, relies on them. I think it's about 8% of the cost of their iPhones. So is it clear how much more money they've had to put towards that and how much of an overhang that could be for them moving forward?
It's not clear from the earnings just yet, but Apple has a pricing power. They're one of the biggest players in the space, and they have long-term contracts and relationship with their suppliers. So I think Apple is, and it's been known that they can squeeze their suppliers quite a bit. And I think what Apple is also doing is they're trying to think through the next, many years, and then trying to get enough supply to be able to provide the memory that they need. And ultimately, I think the Apple infrastructure is very unique in a sense where they have their memory connected to the GPUs. So the way that they build their iPhones and their products, their demand for the memory is very, very specific. So I think the suppliers will want to please Apple going forward.
I want to just take a look at the revenue numbers. We gave out the China number revenue, which did beat expectations. America's revenue for second quarter coming in at 45.09, and the estimate had been 45.82. Is that a big deal when they don't?
I mean, how impressive is that the China numbers, right? Like, I mean, we all were worried about China going down last year, and now China is up almost 30%. So I think really the reality is Apple is, despite all the skepticism, continues to deliver and continues to really beat expectations in many ways. So I think it's very impressive.
Okay, so let's get to the new CEO, because I know there's still a lot of questions about what he will do and his priorities. He's the hardware guy, traditionally. What do you expect his focus to be on?
Well, products. I think it's as simple as that. I think Apple has told us the biggest bottleneck going forward for AI is products. We need to build good products. We need to have the right infrastructure. I think one of the biggest things that John Ternus has done, or one of his biggest successes, is the Apple Silicon, or the Apple chip, the M chips. And that's really why Apple's products are the best to run AI and agents. So I think they're going to keep focusing on products. I also think of form factor. Right now we're using ChatGPT as a really an LLM in a chat box, but I think going forward, form factors, I think I'll expect Apple to bring other products like glasses, like to use some of the AirPods in a way that's going to be very, very interesting. And the way that we're going to be using our AI is going to be very, very different in a few years. And I would bet that Apple will be the company that's going to bring those products to us.
Okay, so let me ask you whether or not they are over the bump that was the Donald Trump tariffs, where China, of course, where they produce a lot of the products, and I know they moved some of it, I believe, to India, but they were getting high rates of tariff, and that was costing the company at one point. I know there was an agreement to lower tariffs or eliminate it in the shorter term. Are they over that bump?
Well, let's recognize, first of all, how skillful Tim Cook has been in managing Donald Trump, right? It's a really tough position to be in as one of the really hardest company from a logistical aspect standpoint, right? You're basically thousands of products. You're building hundreds of millions of products all across the world, and you get a president who's loves tariffs. So I think Tim Cook has done a good job navigating that situation, and also they're investing a lot of money here in the U.S. So this nearshoring or onshoring that's happening by investing in iPhone production and so forth in the U.S., I think is going to be very, very productive for them. The India move, they moved some production, but China is still really where most of the assembly happens. And I think, what Tim is trying to do, or what Tim has done is, they try to diversify their supply chain as much as they can, so they don't suffer as much with Donald Trump's whims, basically.
All right. I do have to leave it there. Hatem, appreciate you as always. Thanks for joining us. Hatem Diab, Managing Partner, Gerber Kawasaki Wealth and Investment Management.
Good to see you.
Coming up, a conversation with the CEO of Aclera. Aclera Resources stock up just over 500% in the past year, driven by interest in rare earth processing and separation. It's the most constrained part of the supply chain. China dominates, and now attention turning to who else can do it. We're joined today by Ramon Barrua, CEO of Aclera Resources.
Our strategy is focused on doing that on an integrated basis. No, we are very fortunate to have two ionic clay deposits. These type of deposits are copy-paste. They're exactly the same as the ones that China have in their southern provinces. And the main attributes there are that the metallurgy is extremely simple, and they also contain the heavy rare earths that, as you probably know, are the most valuable rare earths of them all. But not only do we have the mines and the concentration stages, but we have also announced the development of separation technology in the US. We're developing that technology at Virginia Tech University with the intention of deploying that technology in a plant to be built in the state of Louisiana. So I think that that integrated approach differentiates us from other competitors, given that we will be able to deliver from mine to magnet a solution that is exactly what the US and its allies require right now.
And why do from mine to magnet? Why not just focus on one specific area?
Yes, that was our original plan, but the problem is that the integration with the other stages is rather complex. No, it's not that simple. And we believe that there are significant synergies in terms of costs, speed to market, and operational efficiencies by doing it all together. No, so we believe that through this strategy, we're going to be able to deliver sooner and more cost efficient than any other company in the world, the magnets with heavy rare earths that are needed in the technological industries that require them.
Now, with Virginia Tech and the laboratory partnership you have going, or the Argonne National Laboratory Partnership, it's only a pilot plant. How close are you to the real thing?
Sure. Look, the pilot plant is really the key ingredient. No, once you develop the technology, once you are able to have the ability to separate rare earths, a technology that is specifically designed for our two ionic clay deposits, then deploying that in Louisiana will be rather straightforward. No, the equipment is not sophisticated. It's basically mixer settlers, which are tanks with agitators and pumps. So it's not too complex. The key is designing, how the chemical equilibrium will occur in a series of around 350 to 400 tons, no? Hence also our partnership with the Argonne National Laboratory. With them, we're developing a digital twin where in the pilot plant, we're going to generate at least a couple of years of data that will be fed into this digital twin in order to minimize the risk of ramp up and, again, chemical equilibrium in this sophisticated plant.
And with all this, I mean, the heavy metals, a lot of people, the rare earths, and people look and think it's very dirty. How are you trying to offset the footprint that you may leave behind with this?
Certainly, that's a great question, especially because we have a great answer, no? The reality is that the type of deposit that we have, again, the ionic clays, here, the extraction of the rare earths from those clays is rather easy. The chemical bonding is a very weak bond, and we're able to extract that using just water and ammonium sulfate, which is a common fertilizer. Through the process that we have designed, we do not use any explosives. There's no crushing, there's no milling. We're able to fully recirculate water with 95% efficiency, and we fully recirculate the fertilizer in our system. And most importantly, we do not concentrate radioactivity in our concentrate. We have already achieved a purity of around 97.7%. That's something that we published in our feasibility study from our mine in Brazil. We are targeting a higher number than that in order to bring the product as clean as possible into the U.S. for separation.
Okay, and now you're on the TSX. Anything, and you're going to build this plant down in Louisiana. Do you see any place in Canada that you could be working with?
Not right now. No, we've made a very thorough analysis in order to determine where the best place for the plant was. We have chosen the state of Louisiana because we have acquired an LED certified site that already has most of the permitting already pre-approved by the state. We are also in the process of receiving economic grants in the form of tax exemptions and certain very direct grants from the state as well. There's access to the chemicals that we're going to be needing as reagents in the state. And there's also a very, knowledgeable workforce and consultants near Lake Charles, where we plan on building our plant. So we're very happy with our decision, and we're right now 100% focused on that. In the future, we're looking for other alternatives. No, we have 2 mines, as I mentioned. We don't want to stop there. We're looking for more mines. We're active on the exploration front. And Brazil is a country also that has that is advancing itself to position as a hub for rare earths development. No? So we have not discarded. As a matter of fact, we're looking very seriously at a second separation plant, probably in Brazil in the future.
Ramon Barua is CEO of Aclara Resources. We do want to share some breaking news right now. Air Canada reporting earnings today, and in that announced, because of the volatility in energy prices, it's suspending its full-year forecast for 2026. Like all the other airlines, Air Canada has been paying dramatically higher for fuel because of the Middle East conflict. It's canceled some flight routes as a result. Now, it did also report revenue of $5.8 billion for the latest quarter, beating the estimate of $5.51 billion. Thanks for joining us today on The Close. We'll see you back here again tomorrow.